So we just wanted to share a few thoughts or ideas around how we see the digital space, not only from the investment perspective, but also from an industry standpoint, trying to combine both things. I mean, everybody would agree, and we have a good representation in the room today, that the digital industry has experienced a significant improvement in the last months, or in the last actually years. But we are starting to see some headwinds ahead of us. No one will question the fact that, I mean, we have all the basic ingredients to make sure that digital companies succeed. We have infrastructure in place, which we did not have a few years ago. We have devices, and when I mean devices, I mean these things, that can help us interact and take advantage of the benefits that these digital companies are bringing to us. And is a global industry that is growing probably at the highest pace. The second thing is we see and we feel every day when we order a pizza, when we ask for a new shirt, when we watch some iFlix videos, not Netflix, by the way, but iFlix videos, and when we ask for a taxi, that this is improving the way we live. There are markets that did not exist today and did not exist a few years ago, and now thanks to the digital world, we've managed to create them. I mean, ordering or asking for a taxi in Nigeria was a nightmare until Taxi Grab or Easy Taxi launched. Asking for a pizza in Pakistan was very challenging until Food Panda was launched. Today, this is not the case, right? So we are using it, and it is changing the way we do things. Having said that, we believe that there's a little bit of overheating in valuations, and probably that's not a very well or a very welcome statement in this industry or in this audience, but that's actually what we see. There's still a lot of capital being deployed in fostering that industry, but it's not as healthy as it used to be maybe a couple of years ago. Unicorns are a bit flaky unicorns. I mean, everybody was a unicorn 12 months ago. Your cousin was a unicorn. Your neighbors did a startup that was a unicorn. Everybody had unicorns around. We believe that there's true unicorns, a bit of flaky unicorns as well. And we need to make sure as investors that we split the right ones from the so-called unicorns. And one of the main elements in that is, while there's a lot of very so-called unicorns, there's very few IPOs. So in the 90s, late 90s, the ones that are a bit older, like me, some of you, maybe you were not even here, but I was, the game was about IPOing. Everybody was IPOing companies right, left, and center. Now this is not anymore the case, and the reason is, in order to get an IPO, the public capital markets are asking far more than what they used to ask 10 years ago or 15 years ago in the same stage. So that's definitely something that is changing. And as I said, last but not least, we have two consecutive quarters of VC decreasing investments, and that's a proof that the situation may be overheating. I'm talking mature markets, not that much emerging markets, which I think this is great news for us in the markets where we operate or where you guys operate. The number of deals having hit low since Q1 2013. Again, that's mature markets, not emerging markets. And there's been very few successful IPOs, no, in the space. I think that the conclusion on that, on this first point is, look, digital makes sense. We have all the ingredients to make sure that it succeeds, and it's even more attractive in emerging markets. The guys either launching businesses or investing in so-called emerging markets, I think that have a far higher probability of success than the ones that used to do the same in mature jurisdictions. Having said that, I think that I mean, this is not as gray as some of you guys could potentially think. This is an interesting comparison with the past. We always try to look at the past in order to forecast the future, which is actually not that smart, but few KPIs. In 1999, the US tech funding was $71 billion of 1999. Today, when everybody says that this is overheated, we are talking about 50 billion, not even that. The price-earning ratios that we were recommending investors and we were basing the recommendation to actually invest, it's close to 40 times. Today is less than half of that, 16. The global internet population was about 400 million. Today is 3 billion. And this is linked to the first point I make where I think we have all the ingredients to make sure that we succeed. The US e-commerce revenue is $300+ billion. And you explore that to the mature, so the developed market is even more attractive. Number of IPOs, very few, as I said. Median time of the IPO, 11 years. So the capital market is asking far more from us in order to be in a position to IPO a business. And last but not least, the tech contribution to the S&P, while 15 years ago was over 30%, today is less than 20%. In an environment that is supposed to be far more accommodating to tech companies. So it's true that there's a little bit of overheating, if you will, but it's not as bad as you could think. Second thing is, there's a shift in thinking of investors linked to my previous point. The first one is valuation has been recalibrated. I keep asking some of entrepreneurs or investment groups when they come and say, and they pitch for an investment, say, what's the pre-money valuation? And you get a constant answer, 20 to 25% above the previous funding round. And when you ask why, they look at you like saying, why are you asking this? Every round is 20 to 25%, no? And we feel sometimes that it's difficult to get to those numbers, no? We were still not very clear how to get to a $40+ billion valuation with Uber, but it looks like the Saudi Sovereign Wealth Fund got super comfortable with the $62.5 billion, so let's see. It is true that the global economy is decreasing in terms of growth, and this will have an appetite. The fact that interest rates are growing, which is something extremely boring, but this will have an impact on the amount of capital that we have available. And sometimes very high expectations are not properly backed up, and that's my first point. First thing that we need to look into the business is it real, or this is yet another 20+% from the previous funding round? And having said that, if I had to invest today, most of the portfolio would be on digital companies. And you know that, especially in emerging markets, because as I said at the first point, we're going to jump. All the ingredients are there to make sure that it's successful. Future growth, there's still a lot of capital to be deployed, and there's no one single source of capital. We see now a lot of venture and tech giants deploying capital in digital companies. Why? Not because they are concerned about the return that they're going to get on the investment, but because it's positively affecting their business. And we're very, very committed, if you will, to this intersection between the telecom space and the digital world in emerging markets. The telecom or the digital players that are able to either through investment, through partnerships, through joint ventures, a combination of all the above, to engage telecom operators in their rollout of their products and services in emerging markets, they will definitely get an edge because they are probably the best distribution channels for everything that is digital. The tech space is not over in any shape and form. We have virtual reality, we have Internet of Things, the huge power of analytics, and those are verticals and companies that are available for investors to actually deploy capital. And one last point, which is very interesting, at least for us. the innovation is not anymore happening in Silicon Valley. Silicon Valley has its own ecosystem of people. A lot of smart guys go there because it's cool to live there. It's interesting. There's a lot of capital or VC money available, but it's not anymore the only source of innovation. More and more, we see in Southeast Asia, in the Middle East, Sub-Saharan Africa, entrepreneurs that come not just copycatting whatever was successful in the US, a la Rocket, if you will, but coming up with innovative business models that help the development of the economy in emerging markets. And actually, there's a lot of companies now that are exporting their business models and their operating models to the so-called mature markets. Key conclusions, and I've been doing pretty well with timing. We should expect investor portfolio rebalancing, and there's people that came into funding rounds at probably very rich valuations that they will need to readjust their expectations in the next funding round. And that's something that we are seeing already in the US. That's probably there's an increasing demand of capital moving from the US to emerging markets because we still have high appetite to be exposed to this space, one. Second, public market activity will remain anemic, meaning don't expect many IPOs, or at least the requirements that you will need in order to successfully IPO a business will continue to be quite high. Corporates, and including telcos, will keep deploying capital in this space, not only or not primarily linked to the return that you're going to get in an IPO, in an exit, in a trade sale, whatever it is, but because they enhance the current business model. And corporate venturing, properly executed, we believe that will be extremely powerful and extremely active in this space. And last but not least, digital is the space to be. Digital is the place to invest, and we don't see this changing anytime soon.